So, okay, you give them, let's say 10% to an accelerator.
Yep.
Then you raise kind of your first tranche of safes and you give them another 20%. Then you decide, oh, you need an extension and give away another 20%. 50% of your company at this point is gone.
Hi, everyone. My name is Peter Walker, head of insights at Carta, and welcome back to the Data Minute podcast. On this episode, we were joined by Mendel Chuang, managing director at Acquired Wisdom Fund, who also runs his own venture accelerator known as Founder Friendly Labs. Mendel and I talked on a whole host of subjects today. We started by jumping into a couple charts of Carta data, one on median valuation caps for early stage safes, and the other discussing the difference between a priced and a safe round. And that sort of led us into this broad discussion on the pros and cons of using safes and convertible notes versus priced equity, whether or not founders are too enamored with various accelerators, and how many accelerators is too many to have on a single cap table, and also the mentality that early stage founders should have around hiring, especially in this down moment for venture. I think you're going to really love this conversation. I know I did. Let's jump right in. Mendel, so good to have you in the studio, man.
So good to be talking with you, Peter.
I really appreciate you being here. When we were getting settled off mic, I really was digging into a question about how your fund, Acquired Wisdom Fund, finds the founders that you invest in, because you're looking at this very, very early stage, and I think it's a little bit different than a lot of pre-seed investors. So you want to talk to me about how you find the kind of founders that you're looking for Acquired Wisdom?
Yeah, so for Acquired Wisdom Fund, our goal is to invest in seasoned professionals working on scalable technology products. So people with prior work experience, having worked at places like Google, Microsoft, Apple, a variety of different places where they've gained some experience or they've done some startups.
So they could also just be a repeat founder.
A repeat founder,
okay.
Or they were an early employee at some startup and kind of learn some things before starting what they're working on now.
Yep.
The reason we love working with these kind of founders is that their background, they've learned some things along the way. They've gained some experience that they can bring with them into the startup that they're working on now.
Yep.
And the other thing too is I think having worked at a variety of different places or having gained some experience, you gain a network of friends.
Yep.
And that is super important in our point of view. When you're becoming a founder, when you're starting your own company, you rely on your network. Have a professional network, people you've worked with before, can help you a lot as you work on your startup.
And that's mostly because they can be your first early employees, or are they like angels too? Like what do you think is the biggest benefit there?
Across the board.
Yeah.
So some of it can be an early employee. You're talking to some people about it. Some of it actually is just sounding board. Like you can then, tell them, hey, what you're working on. They give you feedback on whether that is or isn't a good idea.
And you think that like the big company perspective there is really useful? Because one of the things that you hear across the internet sometimes is, the kind of person who works at big tech is not the kind of person who works at startups, and they're like very, very different and they don't actually apply to one another.
I think that comes to personality. So sometimes you're working at a big company. It feels like a big company. You enjoy kind of just being, that very, very small part of a product, and you're going to make that one feature work.
Right.
But some people go into these companies where they really want to make an impact.
Yeah.
Either on a specific customer group or with a specific product. And the big company gives them some of the training wheels so they can see what it looks like when it's working well.
Right.
We have lots of customers, but then they have ideas that they want to pursue that the big company, it's not aligned with their mission, or it's not something that the big company wants to focus on.
Right.
And when they have that passion and drive to build something, that's where they're able to go off and be a founder and work on something really interesting, something that they are passionate about and want to see in the world.
Yeah.
And so you get all that freedom, but you come with some of the knowledge of how companies should work.
Right.
And I think that's a huge advantage for people who have worked at a big company or somewhere else.
That you kind of have seen what success looks like, so you can kind of model yourself. Not obviously at the earliest stages, but like, here's what we're trying to get towards.
Yes, exactly. And you get even some of the best practices. You don't want to copy all of it, because some of it is kind of, when you're managing a much, much larger company and a lot more people, those practices exist. There are checkpoints and stuff like that. You don't need all that at a startup.
Sure.
But some of the basics, such as, okay, this is how we should be talking to customers. This is how you do a usability study.
Right.
This is how we should think about how to be coding our product. What are best practices in terms of just thinking about commenting or testing. All of these things you learn when you've seen it somewhere else,
right,
rather than having to figure it out on your own.
And so when you're meeting these founders, are you typically the first check into these businesses?
We like to go pretty early, and we've seen it across the board. So In terms of finding these founders, going back to your original question here, we see it all across different channels. So for us, we have friends that we know. Some are LPs that have invested in our fund. They may know some people, so we'll get referrals that way. So this kind of word of mouth, like, hey, I know someone who's raising, thinks like it would be a good fit for your fund. They'll do that referral. We also work with other VCs. So one of the nice things is we write a pretty small collaborative check. Our check size is anywhere from $25,000 to $75,000 as our initial check. And so that works really well to fit into just about any round size at the early stage. And so we're not fighting to lead the round. We're not kicking out other VCs. Instead, we work very well with other VCs. So what will happen is sometimes a VC will see something that's very compelling to them, or even something that they've passed on, but they think is a good fit for us. And they will pass it on to us and say, hey, you guys might want to talk to these people. And we will have a conversation with them. And because we're collaborative, they may have invested like the other VC invest, and we'll invest as well. We'll work alongside each other with the startup.
And so most of the time, if you're putting in 50 to 75K, would you say that the rounds that you're typically involved in are more like the startup raises 500, something like that?
So we sit in the pre-seed, maybe a little bit into the seed stage. But what will
your definitions of pre-seed and seed? Let's get into the fun stuff now.
So I think this is where the different sides of it there's no formal definition. Everyone can kind of figure out what is appropriate to them. But in terms of pre-seed, the way I see it is you're kind of very early on your journey. You may have an idea. You may have an initial prototype. You may even be working with a few initial pilot customers. But it's very early. The product's still kind of being formed. And that's where I see with the pre-seed. It involved much more with a little bit kind of about your traction, I guess is the right way to think about it, is have you gotten something someone can play with? Or you're still kind of initial idea? That's where I see more is a pre-seed. Seed, I think, is where you have a solid product where you're starting to see some glimmers of this is something people want to use. So in a B2B case, you may be making a few $100,000 a year. Where there's some traction, something very kind of interesting. And that's what I kind of see more as the seed stage.
Interesting.
And then the A is when things are working really well, and then you have multi-million dollars a year in revenue.
And when you're kind of defining these categories, you've seen some of the data that we have at Carta on how we define it, which is basically based on round size, only because we don't have a lot of the traction metrics, although I'd love to sprinkle that in. But like, when you're talking to founders, do they place themselves in these buckets? They say, I am a pre-seed founder, I am a seed founder, or they're just like, I have this much traction?
I think founders roughly have an idea where they think they belong. And they aren't always right. Because founders, and it makes sense. Founders, you're so busy building your company, building your product, you shouldn't know all the ins and outs of what nomenclature on venture funding round
100%.
Now, if you have a good understanding where you are, it's very helpful because it helps you find the right investors that are interested in what you're doing. And so for founders, I think, some know, some don't, but it's almost a little as nebulous as kind of what investors kind of think about.
It
just, the nomenclature helps some alignment.
I find that some of the terms get too, like, people are kind of sub-segmenting too much and saying, like, we play in this 550 to 650 round size or something, and it's a little too specific, whereas most of the journeys are like far more esoteric than that, which actually, if we wanted to jump into one of the charts that we were talking about earlier, which is priced versus safe. So like I would imagine most of the investments that you do are on through the safe, correct? 100% of them, or
later stage is where we've seen price, but for a pre-seed, we've done all of them on safe.
And so one of the things that we were talking about beforehand that you were a bit surprised by was how some rounds that are going through priced equity are only raising about $1 million, maybe $2 million, and that seems like, well, what's your opinion on that kind of small end of the priced equity round sizes?
So prior to seeing the data from Carta, I'd assumed like price rounds cost, anywhere from 50 to 100,000 is roughly what I'm hearing they say now. And so
that's for a priced seed round.
A priced round, simply because you have to get lawyers involved, and there's a lot more negotiation on all the variety different terms. What I see with the safe is almost kind of taking the easy mode. It is there are all these conversations when you do a priced round that And just to be clear, startups should do a price round at some point. The standard way of getting investors to give your company money is a price round where they get shares back of the company.
Right. And there's due diligence and like a whole host of things that are useful for a company to go through as they grow up.
Exactly.
Yeah.
But a price round involves discussions not only about kind of valuation of the company, but there's a lot of other terms around control. And so it's like, do the investors get a board seat?
Yep.
What about information rights? And then liquidity preferences.
Yep.
And in essence, what a SAFE does is it takes those questions and punts them till later.
Yep.
And so you're kind of taking the easy mode and say, okay, what's the most important thing here? It's probably valuation, and then sometimes this discount thing.
Yep.
Although in reality, it's valuation is kind of the core part of what it happens with a SAFE.
Yeah.
And so in the SAFE, you get to take easy mode, and early on, this makes sense, a lot of sense for founders and startups.
Totally.
Kind of do it in the simplest way as possible, get it done, don't spend a lot of money.
Yep.
Now, what I'm surprised with what I saw in the Carta data is that there are price rounds happening at under $1 million raise.
Yep.
And I think that's surprising to me because most of the founders I talk to and most of the investors I talk to doesn't think it makes sense if you're spending $50,000 to $100,000 to do a round. A good chunk of the amount you raise goes towards just getting that round done, paying the lawyers.
Totally.
And so for the most part, what I've seen is that they take this, they go with the SAFE route, which you don't involve lawyers. You don't have to have a whole bunch of people involved, and you're not negotiating all these extra terms.
I think that's mostly still true. Yeah. Like the data, definitely, there are some founders, and we were maybe it's a geographic thing, maybe it's a founder who's a first-time founder who's a little less sophisticated might not even know that the SAFE is the right way to go for some of these. But the opposite is also true, where now founders are raising $5, $6, $7 million on a SAFE, and that also, whereas the price round, I totally get your point. It's kind of weird to spend that much money on such a small round. It's also sort of weird to not have due diligence if you're giving someone $5 million.
Exactly. Well, so just because you do it on SAFE doesn't mean you don't do due diligence.
Fair enough.
You should still be understanding the startup you're investing in.
Right.
And you're right that it's probably proportional to the amount of money you're putting in.
Yep.
So if you're putting in a small $10,000 check as an angel, definitely they should get some information. Angels should kind of look and you give them enough.
Yeah.
If the angel is asking for a lot of additional information rights or background information, or kind of questioning too much, that might not be a good fit for an early stage angel.
Totally.
Because the check size is so small.
Yeah.
But if someone's writing a $5 million check, now if they do further due diligence, they actually want to reference your customers, talk to people you may have worked with in the past.
Yeah.
That makes more sense. And so diligence should happen whether it's priced or not. Now, the end I kind of see happening, though, is that with SAFEs, it's the easy round. And a lot of these founders go through this process. They've raised on a SAFE. It's easy.
Right.
But at some point, they need to do that priced round.
Yep.
And I think for founders, it's really important to understand price rounds are the norm. And you're going to have to go through at some point, and it's going to take longer.
Yep.
There's more things to negotiate, more things involved. And hopefully it's more money when you're doing the price round.
Yep.
But there's a lot more involved, so you need to give yourself more time for it. And I think that's one of the things founders, particularly who raised in the last few years on SAFEs, need to keep in mind that price rounds take longer and give themselves enough time to do it, give themselves enough runway so they're not like running out of money, given the 6 months it could take, or maybe even a year it could take to raise that round.
One, totally agree. That's fantastic advice for founders. And then two, it seems like what's happened over the last couple of years is this weird mixing of the rounds. Like SAFEs are eating up into price territory. Priced is sometimes still favored by people maybe that are not in Silicon Valley or in other places. And there's this like estuary of mix. But one of the things that we saw in the data recently is that there's been an increase in the number of side letters that are attached to these SAFE rounds. So does Acquired Wisdom have any side letters, or is it basically just a pure SAFE?
Yeah. So we have side letters because we're a VC. And so I think this is actually one of the things for a lot of founders to understand. When you're raising from an individual, they're an angel, they're investing their own money.
Right.
And so they're not obligated to report to anyone else or anyone else saying, hey, what are you doing with
that? Would be a weird report, just like emailing it to yourself. Yeah.
But when it comes to a VC, we have investors, people who gave us their money to invest on their behalf.
Yep.
And so there are things that a safe in easy mode just never address, like are there any information rights?
Yeah.
And that's something for us it's important to have because we have to report this information out to people who gave us their money.
And that's specifically information rights as it relates to the financials of the startup that you're investing in, mostly?
Yeah, so financials, even traction. I think early on there might not be much in terms of financial, but understanding traction and what's going on. This is also why, as a founder, you get requests from investors to give you updates. And you get them, you typically much more so from VCs because they will need to report something back.
Right. They need to have something to say to the people up the chain.
Right.
Yeah.
But it's also a great way for them to help you. So whether it's for VCs or angels, the more they understand what's going on with your company, and they should, you want to tell them what's going on that's going on really well, whether you're getting customers, but also tell them some of the things that aren't working so well, because that's where they can say, oh, if you need help with this, I actually have a friend who can help you with this, or I might know something about that.
Yeah.
And so I think letting others know they've invested in you, they believed in you at one point. And so if you keep them in the loop as to what's going on, it gives them an opportunity to help out.
I think it's a consistent conversation on Twitter and elsewhere about how founders who write regular investor updates are just far more likely to succeed and get the things that they ask for when they talk to investors again. Do you have a specific cadence that you think founders should stick to? Is monthly too often? How often do you need to hear from these folks?
Monthly is fine, but I actually think ultimately it comes down to the founders. And I actually sit on both sides of this debate. I think there are some that giving updates constantly is great. You're getting a lot of it. But then there's some founders that generally know what they need to work on and are very busy working on it and don't have time to send out those updates.
Right.
That's fine as well. But just know that you're at that point, you're kind of you're chugging along on your product. You should have something to show. But if you do at least, I would say probably no less than once a year.
Yeah.
And probably once a month is kind of the other end of the spectrum I've seen.
Gotcha. Yeah, I think that once a month seems pretty heavy for a founder who's moving super quickly, but maybe annually is also not enough granularity for investors to really dig in and be helpful at that moment.
Yeah, I've seen both ends of it, and it really, I think startups are like snowflakes. They're all different,
right?
And founders are different. And so for some founders, the cadence is right for them. They want to be sending it out once a month. Some may send it out once a quarter.
Yeah.
But there's also kind of the other end where the founder generally knows what they're working on. They have their network. If they had questions about specific things, particularly, if they've worked at places before. So kind of the founders we like working with.
Yeah.
They might have a friend that was the marketing specialist or the HR person that they can reach out to. And they don't need to get it through kind of the investor side, but they have friends that they can actually reach out to with those specific questions. The other thing too, I think it's important for a lot of founders to know is investors, advisors, great, have them. They can give some points of advice. But honestly, I think the best advice comes from other founders.
Yeah.
People in the trenches trying to get work done, trying to build certain things. Ideally, you find someone that's one or two steps ahead of you so they can tell you, hey, everyone says you should generally do this, but here's what our experience with.
Right.
So for example, if you're trying to hire and you're trying to hire an engineer, if you know another founder who's gone through that process, you can say, oh, okay, I just saw you hired, one or two engineers. What did you use? And they'll tell you this is the platform I use, or this is a recruiter I use,
right?
And a variety of things. And that can be much more helpful than a mentor and advisor saying, well, 10 years ago, there was this thing I used.
In the .com boom, right? In the back times. Yeah. When I first founded a company.
Yeah, or when mobile was starting. This is how
So do you as Acquired Wisdom, do you introduce your cohorts to each other, your portfolio founders to each other to kind of start that sort of networking?
So one of the neat things about Acquired Wisdom Fund is all our portfolio companies actually get through the accelerator I run as well.
Right.
Founder Riley Labs is the equity-free startup accelerator for seasoned professionals. And so it matches very well with the kind of founders we invest in with Acquired Wisdom Fund. And so what we love is for our founders to meet other founders. And now we treat everyone as adults. So we never say, you over here must go help this other.
Sure. Yeah. You're not forcing friendships. Yeah.
Exactly. Yeah. So it's, and some founders are going to click with certain other founders.
Yeah.
But that's the biggest advice I would give to founders going through this journey. Startups are hard. Most of them are going to fail. And it can also be a very, very lonely thing. So it's important to find your community.
Yeah.
And so find some friends, some other people who are doing this, because it gives you an opportunity to have that conversation about, hey, we got stuck here, or we're starting to do this.
Right.
Like back when I was doing my own startup, one of the most useful things is we were doing a mobile shopping app. And to be able to talk to another founder and say, hey, we're submitting an app to Apple.
Right.
What are some of the things we need to watch out for? And they'd be like, okay, make sure you have these kind of images, put this description here, say yes to this and no to that,
right,
and all these little things. Or they'd be like, yeah, that took me 2 weeks before they reviewed and approved it,
right,
and gave me a framework of saying, okay, it's going to take about 2
So you're not sitting there like
on day 2,
so worried, being like, what is happening? Yeah. Has my app been denied and I don't know it yet? Yeah,
exactly. And so, I mean, and that's great advice for companies that, were 10 years ago or whatever about doing the mobile thing. Now it's a whole different set of things. And so,
which AI provider are you using? All that kind of stuff.
Exactly. And if you can talk to another founder that says, okay, we tried this one and it didn't work well for this, but we tried this other one and it worked much better, it gives you some sets. Now, everything's different. As I was saying, they're a snowflake. Everyone's going to be different and go through different paths. But just knowing some of this, having someone who's explored some of the options, will give you a leg up so that you don't have to explore all of them, but kind of say, okay, the most likely one is going to be this, or we only need to try these 3 instead of these 10.
Totally. Yeah, it kind of just narrows the option set for you so you can make decisions a lot more quickly.
Yep.
And you kind of open the door there to, there's YC Demo Days coming up here in San Francisco. There's a lot of talk about just founders joining accelerators in general, and then maybe even I've seen a couple times where people are talking about founders joining multiple accelerators. Like, what's your view on the kinds of founders for whom accelerators will be useful, or conversely, those that maybe need to bypass it and don't need the accelerators?
I don't think I have a good answer as to why it works or doesn't work for certain people. I think some of it just comes down to timing and luck, where you happen to be, or if you need more guidance in one thing or another, or it's just access to community, I think, is actually probably the key thing out of this. And some people can find that community based on the network of people that they worked with in the past.
Right.
Like if they work somewhere where a lot of people have gone off and started their own companies already,
right.
Tap into that. And, whether you've worked at like Uber or Stripe,
PayPal Mafia,
exactly,
kind of stuff. Yeah.
If they've gone off, you have a network of people you can talk to. And through that, you might find your community. But then there are some where it's just an opportunity to meet other people that, through the accelerator, you form a much stronger bond, and you can find other founders you get along with and keep those relationships.
Yeah.
And that's what I kind of take out. A lot of it comes out through relationship. Now, the thing with accelerators to understand is that most of them take equity.
Right.
And so they do take a chunk of a company, and that's something for each founder to decide if that's appropriate for them to give up at that stage, or if something they don't want.
Do you find when you're kind of having all these talks about different companies with co-investors and et cetera, does the fact that they've given up X amount of equity to an accelerator, is that ever a barrier to your investment?
So there's both pros and cons to this.
Sure.
The pro is that hopefully they've met some community, talked to some people, move them further along. But the con is what you're talking about, is a good chunk of their equity has already been given out.
Right.
So it's typically somewhere between 5 to 10% of the startup is already given out. The other thing I've noticed happening a lot more, and this goes back to kind of the safe conversations, is if founders raise on safes, that's not a real round. You're not
right.
In the reality of it, you didn't actually have the priced round that typically triggers some of these equity stakes that accelerators take.
Definitely.
And so because of this, you're kind of just punting it down the road.
Yep.
And until you have a price round, the early investments, particularly from accelerators or any kind of safes, they just stack on top of each other.
Yes.
Which means the dilution comes from the founders and the teams until that equity round happens and things convert into actual stock and equity ownership in a company.
So just to double down on that, what that means is, say, if you're raising on a post-money safe and you raise at 2 or 3 different safe rounds, quote unquote, those don't it's not as though the money that you raised from the second investor is there's not going to be a dilution from that first investor. That first investor has this like ironclad slice of pie that they're going to get whenever you end up raising priced equity. Yep. And we're running across more and more founders as safes have exploded in popularity that come to the first price round and are shocked at how little of the company they own still. And it seems silly. It's like, of course you would understand that dilution, but it's actually more complex and can sneak up on founders a lot more quickly than they think it can.
Yep, especially if you raise multiple tranches. And to put this into real numbers, it's okay, you've given, let's say, 10% to an accelerator.
Yep.
Then you raise kind of your first tranche of safes and you give them another 20%. Then you decide, oh, you need an extension and give away another 20%. 50% of your company at this point is gone.
Yep.
Whereas had those been distinct rounds, equity rounds, 10% would have converted, then they would have been diluted down by the next round of 20%.
Yes.
And all of them would then have been diluted by the next round of 20%.
Right.
And this is why the standard is actually these price rounds. It's just only in this early stage, founders have an opportunity to do easy mode of raising safes, but you don't want to be in that easy mode too long.
Yep.
Because as you're saying, a lot of founders can be surprised how much of the company they've given away by the time they get to that first price round.
Could not agree more. I think it's the biggest, I don't know if it's an issue with safes or just there's obviously going to be trade-offs for using any type of investment instrument. So it's not like safes are going to solve all these problems.
Yep.
But it is the problem that founders run into most consistently. I'm wondering if you run into the opposite case, which is, have you run across any of these founders that you're speaking with yet who their plan is to raise a little bit of cash, get to revenue, and then never raise again? Like, are you running into more and more people who are attempting that path?
There's definitely some going down this route, but I think it comes down to, and there's some that actually don't even raise at all, so
right.
Completely bootstrapped.
Totally.
And those are really interesting because you're in full control of what happens.
Yep.
But there are some who raise some on safes and then don't really have plans to raise again.
Yep.
But the reason safes exist is that at some point it was supposed to be converted into equity.
Yes.
So the investors who gave you money early on, I mean, so they're expecting you to raise.
They're going to convert that at some point, right?
Right.
But they don't have to. The founder doesn't really have to. There's no forcing function.
Right. There's no forcing function. Prior to safes, there was convertible notes, and I think that still somewhat exists. But
yep.
Convertible notes at least had a interest rate so
right.
that if it took longer, there was still interest accruing.
Yep.
But the other part is there were technically a note that ended at a certain time.
Exactly.
Now, the realities of it, back even when that existed, were more prevalent. Still didn't actually convert because you could hit the end of it and you weren't ready to raise. You could talk to your investors and modify it.
Yep.
But the thought was at least that the expectation is you're going to convert at some point.
Yes.
And that kind of is what the safe expectation is, that it's going to convert at some point.
Yep.
But you're right in essence, a lot of the things that would have forced it to happen went away.
I think it's as we enter this new AI-inflected era where I think a lot of people are going to try to build businesses without a lot of capital raised. I'm a little bit skeptical if they're going to be able to get to the same sort of outcomes. Not to say that revenue funded is bad. I think there's going to be fantastic businesses built that way. But can you get to venture scale really quickly without outside capital? Remains to be seen.
Yeah. There's some talk of AI is allowing some of this to happen. Sure. But I agree with your part. I think with any new technology, it actually just allows the startup to go faster. And right. I think what's interesting with all these startups is you can go in with the idea that you want to become profitable.
Yep.
So that you're not forced to raise at any point. You're going to have enough revenue to kind of keep your business going.
Right.
And that's something I've seen happen. And then it puts you in control as to when is the right time to raise. And that's typically when you see something starting to happen. Let's just say you've tried a few different things and suddenly you have a lot of customer pull in a certain direction.
Right.
And if you could put a little more marketing into it, or you could put a few more engineers on working on that product or that feature, and you just revenue-wise don't have the resources to hire additional people,
right?
This is where raising that next round is very, very helpful.
Right. It's not as though founders only raise in order to keep the business alive.
Right.
The better kind of raise is when the business is going to survive in either case, but I can pour gasoline on this part of the company and we can really explode over the next year or two.
Exactly. You find something interesting. And some of it too, it comes down to, in the tech world, a lot of it is the leaders dominate the market. And second place is okay, but usually it's a huge difference between first and second.
Yep.
And so when you see something interesting, there's a good chance someone else will find that interesting as well.
Yep.
And so if you find it, you see it's interesting, you kind of see an open field, there is some incentive to say, hey, I want to raise the money so I can tackle this and become the leader in the space.
Right.
You don't want to wait so long that someone else starts doing it, and then you become number 2 or number 3 because you didn't pour gasoline on that fire.
There's such a portion of outsized rewards that goes to the leader in a lot of the SaaS businesses in particular that it totally makes sense that you would want to get there first.
Yeah.
I guess that, brings us a little bit to the second chart that we wanted to talk about, maybe as a broader discussion about these early stage startups, which is how valuation caps have trended lately. There's always discussion about how, quote unquote, early stage startups are too highly valued. You hear this with YC Demo Day. You hear this with other things. Like, what is your opinion on how a founder should think about setting their valuation cap, or, what criteria they need to consider when they're trying to think about that?
I will say valuation cap should be set more by the market than by the founder. Now, there's some times where the founder has to kind of decide, this is roughly what I'm hearing, this is where I sit. But founders should really kind of defer to the market, meaning talking to investors, advisors, and kind of saying, okay, this is roughly where we think you fall.
Yeah.
Because investors are seeing way more companies. And what you're doing with the valuation cap is kind of setting your benchmarks against some of the other companies are seeing at that valuation.
Yeah.
And so one of the things that I've heard is that, with a startup, you may have a great business, but it's not always a great investment. And it comes down to how much you're kind of buying into the company for what their valuation cap is kind of set at.
Yeah.
And so one way to think about this is, let's say a founder goes in and says, hey, I think we're roughly at a 5 million valuation. Their investors kind of confirm this is roughly what we're seeing for a startup at your stage.
Yep.
That then, when you go and talk to other investors, they're really kind of aligning you with the others are seeing at around 5 million.
Right.
Maybe they'll compare you against one they've seen at 8, and they're like, oh, actually, you're about that stage.
Right.
You're pretty good at 5. I'm going to do this 5 because it's a great deal.
Right.
And you're pretty good. I would have invested at 8, but I get this at 5. I'm going to come in.
Sure.
And so you're going to attract more that way. It makes the round easier. But the reverse happens as well. Let's say you go in and say, oh, I think we're worth 20, and you get the valuation cap at 20, and other investors looking say, oh, okay, at 20 million valuations, we're seeing companies that have this many customers,
right,
already, that amount of revenue coming in,
right,
and you don't even have a product yet,
right,
or you're not quite sure what product you're building. So we're going to compare you against all the others at the 20 million valuation and decide if it's...
That's actually a really fascinating way. I don't think I've ever heard it before, that the valuation over and above, like, whatever is an intrinsic value of the business, it allows investors to place you in a competitive set. So you're essentially picking your peer group and saying, this is the people that I would like you to compare us to, by setting your valuation at one point or another.
Right. In essence, it kind of when they see, hey, I could invest in this company at 20 million or that company at 20 million.
Yeah.
Some, at the 20 million, maybe further along than you are. And so you're just setting your bar higher. Doesn't mean you won't get it done. You might find someone out there that says,
for sure,
I find something really, really compelling about this, or your background or some of these things really kind of make it so I'm willing to pay that price for this.
Yep.
But at the same time, with a lot of investors, you're setting yourself in that peer group. And so understanding what they're seeing in that peer group really does affect things.
And what percentage of the companies that you pass on do you think you would have invested in had the valuation cap been more to your liking? Like, is it that final tipping point, or is it this really big, like, gating criteria for you?
I think they're all the investors that sit on all spectrums of this, where there's some investors that say, you get up in so early, the valuation doesn't really matter.
Right. Yeah.
Because if it works, it works. And if it doesn't, it was going to zero anyway.
For sure.
And so there's some that sit on that end, which are not valuation sensitive. We are more on the valuation sensitive side. And for us, the way we look at it is trying to get a multiple on the money, the return. And so if we're investing in a company at a 5 million valuation, it's much easier to get a 10x return on that than it is if, let's say, we're investing in a company at a 20 million valuation.
For sure.
So the 10x, if they get to 50 million, great. That's a small exit in the kind of the grand schemes of the venture world, but would actually be pretty interesting versus, getting the 20 million and getting a 10x there. You have to get to 200 million.
Sure.
And this goes crazy when you're looking at the 100x returns, which most VCs look for. Now you're, talking about a $500 million exit for kind of the 5 million thing versus having a $2 billion exit.
Right. Yeah. Those are big gaps.
Yeah.
Not especially in this market, like the chances of that happening. And I think that is something that more founders should consider, just that funds, especially once you move past the angel rounds, funds are working on an economic model that prioritizes the absolute grand slams. Like these need to be really big businesses for it to make sense. So that's why the sensitivity to the entry point. I'm actually kind of surprised that there's a lot of investors who aren't as sensitive to the valuation.
I think it happened a lot more in the last few years where it was the exit point just seemed outrageous.
Right.
Getting a $10 billion company was no longer this rarity, but actually seemed to be more common.
Right.
And so there was some thought the exit points were just getting much, much more common.
Yep.
Now, few years down the road, we've seen that, that's actually not the case.
Yep.
It is still very hard to build even $1 billion business, but it's not just a $10 billion plus business.
Yep.
And so I think a lot of investors are rethinking that.
Yeah.
But there's still a spectrum of how sensitive an investor is to the entry point.
Right. Do you have any, I know we're going to wrap up here in a moment, but any other advice for founders just about the mentality of pre-seed VCs right now? Like, obviously the market is down. It was a really slow 2023. We're seeing some glimmers of some pickup in activity for investment in pre-seed in 2024. But like, what's one or two things that you wish founders considered about the investor perspective?
Yeah. So one of the things I think is really important for a lot of founders to realize is doing a startup is hard. I know it's been glamorized and there's a lot of like, oh, we get to do this.
Sure.
But just working on a startup is really hard. For the kind of founders we like working with, where they've gained some experience and worked somewhere else, the other thing we often recommend to them is build up a runway. So like a personal runway. Have enough in your nest egg to go 6 months, 12 months, or maybe even longer without taking a salary.
Yeah.
And that's because at early stage in a startup, you're building this kind of on your own, or you with your co-founder.
Yeah.
But you're going to have to go a while without having salary or revenue.
Yeah.
And so as you kind of build this out, and so giving yourself a runway, being able to be scrappy as you work on your startup, I think is really important. And what that translates into is if you are able to be scrappy and you're working on something you're really passionate about, that you believe needs to be in the world, that'll translate when you go to raise your pre-seed round. So when you go talking to investors and say, look how far we got, I believe so much in this, that I've been working on this thing, and here's our initial prototype, or this is what we've learned about the market in this time that we've worked on it, that scrappiness will translate. And I think helps a lot when you go to raise your pre-seed round.
Yeah.
The other part too, for particularly the seasoned professionals we work with, is a startup is not just simply a smaller big business. And so you don't need to hire everyone for all the functions you had.
Yeah.
Oftentimes it's going to be the CEO has to take on a lot of roles, whether it's legal, HR, finding office space, whatever it may be.
Yeah.
The CEO has to take that on initially. And it's typically going to be you and a co-founder, where the two of you will kind of just take on extra things, but be scrappy and try to do it with a small team. Now, I've heard AI is starting to be very helpful in this. Sure.
Yeah.
It allows you to be more effective. And so there's a lot of talk right now of, can you really get $1 billion company? Well, we'll be seeing this where it's just a very small team, maybe just a handful of people,
right,
and get to a really large company using AI and leveraging all that it can do.
Do you see that founders, as like a final note, do you see that founders are trying to plug in fractional execs or fractional people or even consultants to plug those holes? Or is it really like you should be doing all of this yourself and kind of figure out how to scrap by?
At the early stage in pre-seed, you should try to be doing it yourself. Get advice. And this is where having the peers, people that can help you with this, try to do as much of it yourself. Now, there's certain things I think you should definitely get other people to help with. So if there's some legal thing, you probably want to talk to...
If you're not a lawyer, that's not a good idea.
Right. Yeah. So something like that. But the other thing, too, comes down with taxes. I think some founders try to file it on their own. And if it's simple enough, it's okay. But I've seen that also blow up a lot. In essence, you miss some form or miss something, and you have to now go back and revise all of it.
Yeah.
And it'll kick in when there's an external investor. So I would say taxes, find an external accountant to help you file those taxes.
Yep.
And then legal thing, I think are kind of two big things. But other than that, like, let's say you're trying to figure out marketing and you've never done marketing before, but you're going to figure out how, like, talk about your product, some of these things. Get some advice, get some people that may say, oh yeah, this is what you want to look on if you're going to advertise on Google. Here's how to do keyword stuff, or here's how we did it on Facebook. And this is kind of the something, but learn some of it yourself. And you're not going to be the best at it.
Sure.
We all know this, but I actually think that's some of the most fun you get to be as a founder in a startup, is that you get to learn all of these things that had you been in a larger company, you never would have got to try.
Right. Yeah.
And so I think, yes, sometimes it sucks. Like, I don't want to be dealing with some weird HR thing of like, okay, I have to get people to sign PIAs or whatever. And it's like, but I know it. Or I think even early on, thinking about like, what's the difference between a C Corp and an LLC? As a, had you worked in a large company, you never had any of these considerations. But as a founder, you get to think about it.
Right.
And so,
side note, if you want VC investment, C Corp is the way to go there.
Yes. Yeah. You want to get C Corp or VC. But there's some founders that will start as an LLC, see if anything interesting comes out of it, and then convert to a C Corp.
Yep.
Or there's the in-between, an S Corp. But there's all these different things that you could, is possible in the startup world that as a founder you get to learn about.
Yeah.
That no other time would this be something that you have to even think about, but you get to know about it. And I think it's helpful or kind of fun as a founder. You get to obtain all these skills and all this knowledge that you get to develop. I think that's like one of the most interesting things as a founder.
For sure.
To explore these. So don't do it all on your own. Get your community, talk to some people. And this is like, if they're thinking about an LLC or a C Corp, and you don't understand what these are, lots of resources online, definitely check those out. But if you can find someone 1 or 2 steps ahead of you who incorporated and went through that decision, you can talk to them and say, hey, what did you consider?
Right.
And why did you decide? And they might not have the right answer. They say, well, we went with this mostly because, and it might not be the right thing for you, but at least you understand it. And if you talk to just a few people, the amount of knowledge you gain about it is huge and will help you decide what you should do.
No doubt. I mean, if you're not there to embrace the curiosity and like all the new adventure stuff, then that's got to be a huge part of being wrapped into building this new business in the first place, right? So like, that's the fun stuff, right?
Yeah. And so don't go out there and immediately hire kind of the chief of marketing because you've never done marketing before, so you don't want to touch it.
Right.
As a founder, you should somewhat try it and learn, oh, this is kind of interesting or definitely not interesting, but at least here's my initial learnings. Is like, if we target these kind of customers, they respond well.
Right.
And these other types don't respond well. You have some basic knowledge. And when you get large enough, when you kind of raise the bigger round and you're starting to pour gasoline on the fire, that's when you can bring in someone to say, all right, take over this function. I'm definitely not the best at it, but here's what I can tell you.
Here's the 2 pages that I learned about it that are going to be important for your job moving forward, all that kind of stuff.
Yeah, right. And now you can run with it. But that's when you're pouring gasoline on the fire, definitely not when you're first trying to figure out the company.
Right. And I do think founders have been a little bit more conservative and reserved when it comes to hiring, at least from our data this year, than they have been in the last 4 or 5. So that's probably a healthy thing for the ecosystem as a whole.
I think it's an amazing thing for founders because you want to be small and scrappy. And it goes back to where we started, where it's really important for founders. And the other part of being scrappy and having a small team is you can adjust much more quickly.
Yeah. Well,
I think oftentimes it gets lost, particularly people who've worked at large companies, that you can get a team of 5 or 10, but if you need to pivot, which startups do all the time, or even slightly adjust what you're building, when you have 2 people, it's that simple conversation.
Right.
And it happened all the time when I was doing it, when I owned startup. I'd turn to my co-founder and say, hey, I don't think this is working. Do you also think this isn't working? And be like, yeah, I don't think it's working.
Right. Yeah.
Done. We change.
Company decides.
Yeah. I don't need to go to 5 other people and say, hey, do you also think this or whatever?
Yep.
It really kind of makes it easy. So you can be much more nimble as a small company as well. So that's the other huge benefit of not having kind of this chief of marketing and have to explain, well, we decided not to do this. I know you spent a month trying to build a marketing plan.
It's going to mess up your roadmap, but it just wasn't working, blah, blah, blah. Yeah.
Yeah. So, at early stages is really important for startups to be nimble.
Yeah. Well said. I mean, this was an education, Mendel. I really appreciate you being here. Where can people kind of find Acquired Wisdom and learn more about you?
Yeah. So check us out at awf.vc. That's our website. If you're interested in pitching us, there's a link to a form on there. There's a pitch. You can just pitch us from the website, fill out the form, and we will get back to you.
Amazing, man. Thank you so much for the time.
All right. Thank you.
Cheers, Mendel.